Let's picture two people checking their retirement accounts this morning. First up, you've got that coworker who literally will not shut up about how their portfolio is up massive amounts this year because they just went all in on AI and NVIDIA. And then there's you. You did the responsible thing, right? You bought a boring, perfectly diversified S&P 500 index fund years ago. You're a sensible adult. You don't gamble on stock picking. But what if I told you that the reality of what you actually own right now is very, very different from what you think? Welcome to The Explainer. Let's get right into it. So I want to ask you this directly and really think about it. Do you know what's actually hiding inside your 401k today? Because here's the secret that nobody is telling you. You own NVIDIA too. In fact, you probably own a ton of it. You might actually own more of that one single stock than you do of 400 other companies in your quote-unquote diversified fund combined. You just didn't realize it yet. And this completely exposes the illusion. On the left side here, when you blindly buy a Vanguard or Fidelity fund, you think you're buying a tiny, safe slice of 500 different, equally healthy American companies. It's safe, right? But the jarring reality is what you see on the right. You're actually making a massive, highly concentrated bet on just 7 tech giants. And those other 493 companies, they're basically just a hedge sprinkled on top for decoration. When you look at the sheer math of this concentration, it is genuinely staggering. Just 7 companies, NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, and Tesla, now make up roughly 35% of the entire index. To put that into perspective, back in 2016, those exact same 7 stocks were only about 12% of the index. They've almost tripled their weight in less than a decade. The math has literally chosen your portfolio for you while you were asleep at the wheel. Now, here is why that is absolutely crucial to understand. In 2025, those 7 exact stocks were responsible for a staggering 42% of the total returns of the entire index. And it actually gets crazier. So far this year, NVIDIA alone has contributed about a fifth of all the gains. One single stock is driving 20% of the entire market that your life savings is sitting in. If NVIDIA takes a hit, your boring, sensible index fund is going right down with it. All right, let's move to part 1, the historical valuation warning. Look, concentration alone isn't fatal, obviously. It only really matters when something cracks. So the big question we have to answer in this explainer is, how expensive have these stocks actually gotten? Economists measure this by looking at how many years of company earnings you're paying to own $1 worth of stock. Historically, going all the way back to 1880, that average is 17 years. In 1929, the year of the Great Crash, it was 32. And today, we are sitting at almost 40. Actually, the only time in 145 years of U.S. history this number has been higher was December 1999, right before the dot-com bubble popped. We're statistically sitting in the second most expensive stock market in American history. If you want another way to wrap your head around it, consider this number, 231%. That represents the total value of all public U.S. stocks compared to the size of the entire U.S. economy. Before the 2000 crash, it was 146%. Before 2008, it was 109%. At 231%, we are at an all-time unprecedented record. Think about it. That's exactly like a single-corner restaurant being valued at more than the entire neighborhood it operates in. At some point, the math just has to bend back to reality. Which brings us to part 2, the AI spending paradox. So you're probably wondering, why on earth are stocks this wildly expensive? What's the justification? Well, it all comes down to absolute, unadulterated euphoria surrounding artificial intelligence. The entire bull case here rests on this bet that AI will deliver massive productivity gains. And the spending to get there, it's astronomical. Microsoft, Google, Meta, and Amazon are planning to spend roughly $725 billion on AI infrastructure in a single year. That is a 77% increase from last year, and it's literally more than the entire annual GDP of Sweden. 4 companies are spending an entire developed country's worth of money on data centers in 12 months. Amazon is even burning cash right now, operating with negative free cash flow just to keep up in the race. But here is where the whole thing gets genuinely wild. This circular loop of AI spending is starting to look exactly like a snake eating its own tail. Look at this. Step 1. NVIDIA pledges $100 billion to OpenAI. Okay. Step 2. OpenAI turns right around and signs a $300 billion cloud computing contract with Oracle. And step 3. Oracle raises billions of dollars to go buy NVIDIA chips to fulfill that exact contract. They're literally just writing each other massive checks and counting the whole shebang as revenue. And that brings us to the actual receipts. A recent MIT study looked at 300 real-world corporate AI deployments. The result? 95% of these organizations are seeing zero measurable return on their AI investments. Not low returns, zero, zilch. We are spending close to $1 trillion a year on a technology that, for the vast majority of corporations right now, isn't generating actual profit. Eventually, the people writing these massive checks are going to demand to see the receipts.
Part 3. Debt, Rates, and Cockroaches.
I want us to take a breath here and just slow down the pace for a second, because really expensive stocks demand an absolutely perfect economic environment to survive. And right now, the macro headwinds out there are severe. Inflation is stuck at 3.8%. The Federal Reserve, who everyone thought was definitely going to cut interest rates, has completely pivoted. Wall Street is actually pricing in a 37% chance of a rate hike now. Meanwhile, the 30-year Treasury yield recently hit 5.19%. Why does that matter to you? Well, when you can lend money to the U.S. government and get a guaranteed 5% return with zero risk, paying 40 times earnings for highly concentrated tech stocks starts to look, honestly, a bit foolish. The gravity here is getting much, much heavier. And then, of course, there's the government debt, which has now crossed $38 trillion. Ray Dalio, the guy who runs the largest hedge fund on the planet with $150 billion under management, recently referred to our current situation as a debt death spiral. When a legendary investor uses a phrase like that to describe the fact that we now pay over $1 trillion a year just in interest on our national debt, we should probably stop and write that down. Now, what's really interesting here is that we are starting to see the warning shots. Remember early 2007, right before the housing crash, when these random subprime lenders just quietly started failing? We're seeing that exact pattern play out right now in the credit markets. In just the past 6 months, a subprime auto lender committed fraud and triggered massive bank losses. An auto parts company called First Brands collapsed because, oops, they hid massive 20-to-1 leverage off their balance sheets. And regional banks are suddenly getting hit by bad loans that nobody was paying attention to. Which led to this absolutely incredible quote. Jamie Dimon, the CEO of JP Morgan, literally the largest bank in America, publicly stated, "When you see one cockroach, there are probably more." He is boldly comparing the current U.S. credit market to a cockroach infestation. Guys, that is a massive warning sign coming from the very person whose entire job is to keep the financial system calm. Let's look at part 4, the smart money retreat. So let's recap. You've got record valuations, massive concentration, an AI spending paradox, sticky inflation, and credit cockroaches. You have every right to be concerned. So let's look at what the most experienced, legendary investors in the world are actually doing about this math right now. Because while regular retail investors are borrowing money on margin to buy stocks, the legends are rushing for the exits. Warren Buffett is sitting on a record $397 billion in cash. That's over 30% of Berkshire's assets. Michael Burry from The Big Short is taking heavy short positions on tech. Legendary manager Stanley Druckenmiller completely sold out of his entire Alphabet position in a single quarter. And John Hussman's models, they're currently implying a 63% market drop. The smart money is aggressively playing defense. And this perfectly captures why most people get caught off guard. Bank of America's chief strategist summed it up beautifully. The top is a process, the bottom is a moment. Just let that sink in for a second. Market tops do not ring a bell. They drag on with euphoria for months. People get richer, they mock you for being cautious, the party just keeps going. But the crash, the bottom, that hits suddenly on a random Tuesday without any warning, trapping everyone who waited too long. Finally, part 5, navigating the process. So what's the takeaway? How do we actually navigate this? I am absolutely not telling you to panic and sell everything tomorrow. Trying to time the exact top is a fool's game. But let's talk about the practical, boring, actionable steps you can take to protect yourself while the music is still playing. Look, human neuroscience is brutal. Your brain really wants to buy into the euphoria. You have to fight that urge. Do the boring stuff. Log in and check your actual allocations. If you're 100% in a standard S&P 500 fund, remember you are heavily concentrated in tech. Consider equal weight S&P funds that actually balance out the 500 companies. Look into some international exposure or maybe bonds. And seriously, don't be afraid to hold cash. Cash is currently paying around 4% risk-free. Warren Buffett is allowed to hold billions of it, and you're allowed to hold a little too. The market process is still playing out right now. The headlines are wildly optimistic, and your coworker is definitely still bragging. But history shows us time and time again that this is exactly what the late stages of every bubble look like. You don't get to choose whether the moment comes, you only get to choose if you're the one left holding the bag when it does. Take a hard look at your 401k today. Ask yourself, are you ready for the moment? Thanks for joining me on this explainer. Keep learning, stay vigilant, and I'll catch you next time.